Welcome back. This is starting to get exciting now. We're going to be talking about some things today that I think that you're going to be really interested in. Now, just to let you know, since I did this the last one, I had some people question me and ask me questions about, is it legal to do any of this? Okay, first of all, everything we're going to teach you and help you to do is legal. Now, let me tell you about what the idea of that. There was a judge in Kentucky, and he actually had to go across a river to go home each night. And he was talking one time, he says, when I go across the river, there's a toll booth, and I have to pay a $5 toll to get across the river. Now, if I went 2 miles down the road, there's another bridge that goes across, and it's a free bridge. All right. And he says, when there's something that's free, that means that the government's trying to encourage you to do this. So they're trying to get the traffic off of the first bridge to go to the second bridge. And so the deal is, he said, if I go and I ram my way through that toll and I don't pay the $5, that's tax evasion, and I should be going to prison for that. But if I take the time to do what the government wants me to do anyway, go down to the free bridge and go across that, that's tax planning, and I should be commended for it. So that's the idea you need to think here. We're not going to sit here and show you how to not pay taxes when you should. If you should pay taxes, you just need to do it. But let's find ways that will make it so you can legally and properly and ethically not owe some of those taxes. Okay? I mean, wasn't it, I think it was Madison that said, any man who pays more taxes than he must is a fool. And I'm of that variety. I agree with him. I'm happy to pay my share. Not going to pay more than I have to. I'm not going to do any tax evasion, but I'm definitely going to do some tax planning. So with that said, last time we ended up, we were talking about how we have money that's going to flow from our corporation into our limited partnership. When it's in the corporation, if it comes out to us directly, it's immediately taxed. They take the money out before they even get your check. But if it goes into the limited partnership, because we're paying for services provided, whether it be rent on the property that you're in, or whether it be rent on the equipment that you're using, or services such as marketing or things that we're doing for the corporation, we have a reason for that to come out. And we talk about that. Everybody's got different reasons, different purposes, and there's a million ways to take care of that. So we'll be able to help you figure out what's best for you. But now the money, we have the issue that the money's in the limited partnership, and we need to do something with it. Because what happens if it's still in the partnership at the end of the year? You're going to get a K-1 saying this is profit, you pay tax on it. We didn't get any tax benefits on that. Because if you either pay it either in the corporation, or you're going to pay it directly if you get it out as salary, or you're going to pay it on a K-1 on your own personal tax return if it's still there. So we got to do something with this money. So is it my philosophy that you need to go find all kinds of ways to spend this money? No. I would never, ever suggest that you go and spend money on something you wouldn't spend it for already. Okay, so the deal is if it's not something that you're going to do, don't do it. I'd rather you pay a little bit of tax on it than use it all for something that's useless. And so the deal is we need to find out what you're already spending money for. So you sit there and say, okay, well, I ask you, what do you like to do? And say, well, we like to go and travel around the United States. Okay, well, that I can handle. I can work with that, okay? When you go out and travel around the United States, what do you do? Oh, we visit landmarks, we visit family, we visit different things like this type of thing. I said, that's great. The places that you go, this would be my next question. In the places that you go, is there any real property? And your answer is always going to be yes. There's real property everywhere. Okay? And so the deal is, you say, okay, where do you go? You say, I go to Georgia. I visit my sister in Georgia. I say, do they have real property in Georgia? And you say, sure, they have real property in Georgia. I say, well, what does your limited partnership own? Well, it owns 2 rentals. It owns our house and our building. And it says, well, you're already dealing in real property. Why not look at some other properties while you're in Georgia and make this a tax-deductible expense, a business trip? And you're going to spend 2 or 3 hours looking at properties, and the rest of the time you're going to spend with your sister. And so this is the deal: is before I go out and I go on one of these trips, I actually call and I make an appointment with a realtor. And I say, hey, listen, I'm looking for some more rental stock. I'd love to see some properties that you have there in this area in Georgia. And would you be able to spend 2 or 3 hours with me showing me some properties? And so they always say yes. Nobody's ever said no so far. And so they always say yes. And you go out there and they show you 3 or 4 or 5 properties. They give you the little papers that show that you have gone and seen the properties. You get their card. You attach your receipts to that, and it just became a business trip. So let me give you an example. What do you get to write off with this money that's sitting here in the limited partnership? You get to write off the plane fare going out to Georgia. You get to write off the rental car that you had to rent while you're in Georgia. You get to write off the food. Of course, you don't get the whole thing as a deduction, but you get half of it, I believe, at the moment. So you get to write that off. You get to write off the hotel that you're at while you're in Georgia. You do not get to write off Disney World tickets or Sunsplash Mountain tickets or all that type of thing that has to do with going out and playing. That has nothing to do with the limited partnership. And so it's not a tax deduction for the limited partnership. And just to let you know, as you're writing things off as tax deductible for the limited partnership, you always want to kind of put it through the eye-to-eye test is what I call it. So if you can sit there and stand in front of an IRS agent and he asks, why did you deduct this? If you can look him in the eye and say, this is why I deducted this and this is why I think it's proper, that's what we want you to do. If you're going to be sitting there looking at your fingernails and looking at the floor and looking around to see what bugs are on the ceiling, don't take that deduction. Don't do it, because if you can't even convince yourself this is an appropriate thing, then it's not going to be appropriate for you. And there's going to be different appropriateness for different people. Some people will be more aggressive on taking deductions, legal deductions. I'm not ever talking about illegal deductions. Some people are going to be more tentative on what deductions they take. I'm kind of a more aggressive one, to tell you the truth. I talk to my CPA and says, is there anything that says I can't do this as a deduction? And if he says, no, there's nothing that says you can't do it, then I do it. But if he says, yeah, there's this thing over here that says you can't do that, I don't do it. That's how you handle it. So that's the deal, is that you're going to go ahead and say, okay, I'm going to deduct that whole trip. Let's say that Georgia trip was a $10,000 trip. All right, and you spent $500 on playing around, going to the water slide and all that type of thing. So $9,500 of it was what was not taken care of, the water slide. That's the part that can be tax deductible, because you actually went out and did things on behalf of your limited partnership. And to tell you the truth, I've actually done that. I went to Hawaii one time, did that very same thing, ended up buying a house in Hawaii. Okay, and so it was great, and I rented it for 10 or so years, and then I was able to sell it. But the deal is, you just might go out there and find a great deal that's exactly what you're looking for anyway. So turn your travel into tax deductible expenses. So there's one way to do it. Let's say you're going to go out to eat. Okay, and so what are you going to do when you're out eating? You're going to go ahead and think about and work on the things that your limited partnership and your corporation are doing. That's what you're going to do every time. If you go with your wife, that's what you're going to talk about. You know that. Oh, this is the rentals doing this. This is what's going on this. If you go by yourself, you're going to sit there and plan on what you're going to do it. If you go out with others, then you're going to go ahead. They can become clients. And so you can do this. So you can deduct almost every time you go out to eat. Okay? Legally, without having to worry about it. Now, how do you make sure that you know why that's deductible each time? Well, the way I do it is when I'm at the restaurant, after I've actually done something on behalf of my entities, I actually take the receipt. So they give me the receipt. There's people behind me waiting to sign, but I'm not worrying about them. They can do it at their own time. I turn the receipt over and I write on it exactly what I did. I discussed what I'm going to do with this house, okay? I went ahead and say, we're going to go ahead and maybe look at places in Ohio. We're going to go ahead, take care of the things that need to be done. And so I'm able to go ahead, and as long as I keep that record, if I'm ever audited, and we're going to talk about that in the next session, okay? But if I'm ever audited, I can pull those out, turn those over, and say, this is what I did for that time. And I can look that IRS agent in the eye and feel comfortable in what I'm doing, okay? So the deal is, though there's things you can do to make sure that what you're already doing can become tax deductible. Can it make everything you're doing tax deductible? No. Okay, and that's fine, okay? But the deal is if we can even make half of it tax deductible legally in a way that should be done, what a blessing that would be for anybody to be able to say, hey, instead of getting $6,000 a month out of that 10, you can say to your wife, you're going to get 8 instead. Wouldn't that be nice? So anyway, we're going to go on with this idea of what we do to use those assets in a tax deductible way in the next session. So don't forget to come on in and we'll give you some more ideas. Okay? Thank you much.